What's up, everybody? In today's video, I'm going to be walking through the strategic transaction value lens, which is the third lens on how to think about business valuations. If you've not gone and checked out the owner's utility lens or the market valuation lens videos and articles, I highly recommend going and doing so. I also have an overview video, and I'm going to be building on a lot of those concepts because that's the way that this pyramid works, where we're looking at the company through first, what does it mean to us? So to you, what's it mean to you? What's it worth for your time, your cash flow, and your wealth? And then from the market valuation, there are 4 KPIs that we talked about, which is normalized EBITDA, the multiple, net debt, and normalized working capital. And then we have a specific buyer and deal structure that is at the table that you're going to have to weigh it through. What does it mean to you and your goals of time, cash, and wealth? Also, how could that valuation and how does that valuation compare to all other buyers, ESOPs, private equity, strategic buyers based on the 4 KPIs? And then what does it mean to you? So you're thinking about it from on the way up and the way down to say, okay, is this worth looking at right now? Is there a deal on the table that maybe I get a premium or I've got leverage, the market's hot in my industry? We're going to help you think about how to weigh these options and how to weigh different deals and different structures against your goals and what you want, how to compare them with a couple different lenses. There's a PDF below if you want to follow along while I'm going through this long form video and doing this training, so you can actually follow along and actually be writing some notes and dropping down a bunch of the material that I'm going to be going through. So the third lens comes because we have a specific buyer in mind and we have to weigh, again, the specific deal structure in that buyer. But before we do, I just need to constantly orient ourselves, which is why are we thinking about all this? It's independence. We all want to build a business that gives us the freedom over time, cash flow, and wealth, whether you own the company, step back, scale, acquire, or sell. We want to make sure that you're constantly on track to having more freedom. And the way to think about this is through the independence flywheel lens. And this is about taking your time and working to generate cash flow, taking that cash flow and investing it into wealth generating assets like the company or anything outside the company, so we can generate income that's not tied to our time. And then we just keep that flywheel going. And the whole point is that every decision that we're making should be an investment of time, cash flow, wealth. There's always trade-offs of these first principle constraints. And we want to make sure that we're having accelerated momentum towards independence and having the flexibility of doing whatever we want while we own the company or not. And that's all driven by the independence by design framework, which is the owner's playbook to decouple our cash flow from our time while generating wealth in an asset. And that's why we're thinking about these 3 lenses of valuations to understand, how is my wealth getting generated? How do I quantify it? And what are my options? And then we create escape velocity through these 3 phases, so we can hit independence escape velocity, where we can do whatever we want because we've decoupled our time and our cash flow. And then we know that we can sell the company or keep the company, and it still allows us independence. In each of those phases, we are going to be focused on the plan phase and this first module, which is expand knowledge. And what we have to do to expand knowledge is we have to understand how the game of ownership works. And the game of ownership is understanding how companies are valued and how to think about valuations, because we have no idea how to judge whether it's worth it or not, whether we're going to reinvest, whatever our strategies are, spend the time, invest the money, we need to get the return. And we have to understand the 3 lenses of valuations to actually quantify that return. And we can track and measure all of this stuff. So again, today we are going to be talking about this top of the pyramid, because it's when a specific situation is in front of us, how does that cascade and how do we weigh and judge that against reference points of what it means to us from our time and our cash flow in the owner's utility, all the different valuations that we can get in the marketplace, regardless of the buyer, based on the 4 KPIs. And we have to start from this lens of, what is the company? What do you want? This right here, these goals of yours, It's the most important thing because they drive everything. And I'm going to explain how the various types of ownership structures, ESOPs, private equity, family office, all of those different ownership structures will dictate their own timeline for cash flow targets, equity targets within what timeline. But you, as the privately held owner, you have to come up with and say, okay, my time, I'm working 50 hours in the business. I want to go to 20 hours. I want to take my cash flow. And what I want to do with that cash flow is I want to increase the cash flow from distribution. So I want to go from 200 to 500, and I want to reduce my salary over that timeline because we're able to get your cash flow from distributions from the cash flow statement, not your W-2, which is in the income statement. All of this is unpacked in great detail in the owner's utility lens. And then we look over here and we say, okay, well, what's this wealth gap? And how does my business valuation fit into that? So we're trying to quantify that gap and then understand how do we first reinvest into something that you can control, which is the cash flow of the company and your time. And then how does that compare to the 4 KPIs? Sorry, I could switch to the pen, and then what does that mean to a buyer? So this is the foundation. So again, I'm just level setting us because now what we're going to do is I'm going to give a quick 30,000 foot overview of each of the first 2 lenses. And then we're going to jump into deal structures, ownership structures, and then how to think about all the different types of buyers and what that means to you and what the different ranges of the different buyers, the structures, what's common to each different type of buyer, and then what's the process of taking a company to market so that way you can make sure that you have the highest amount of options as possible. So we have to start with lens 1, and this is based on the discounted cash flow. So it's based on this discounted cash flow, which what we did is we took the stream of distributions. And again, if you want to know what I mean by distributions, go check out the owner's utility lens. We take that stream of distributions and then we discount it to today based on a percentage that is based on the risk of those future cash flows. And there's a lot of things in the first and second lens about how do we actually de-risk that cash flow and how do we increase that multiple by decreasing this. We want to decrease that, which increase. So if we took that from 25 to 15, we would then be able to increase the multiple because we take 1 divided by the multiple. I'm sorry. Yep. 1 divided by, the discounted cash flow rate. And that gets us to the multiple. Again, a lot more about that in the previous ones, but what we're doing is we're taking this stream of cash flow, we're discounting it. And then there's something called the terminal value, which is the valuation of the company at that point in time. So then you're also taking and you're discounting that to the future based on that percentage. The whole point of me bringing this up and level setting us is because this stream of cash flow is what you want to decouple your time from your cash flow to get your cash flow from distributions. And so the more predictability you have over it, the more that you like it, the more that we can actually discount, or the more we can reduce that discount rate, the better things get. So this is all knowable in the 3-statement financial forecast, and you can actually go check that out where you can actually see all of the stuff in the cash flow statement. I break that down in the owner's utility lens. The second lens is the market valuation, where we're taking the 4 main KPIs, which is normalized EBITDA times the multiple. This is just the proxy for cash flow, normal level of cash flow. This is a proxy for the number of years of cash flow based on the risk. Then we have to deliver a cash-free, debt-free company, regardless of the buyer. And then we have to deliver a normal level of capital, working capital, which is inventory, payables, and receivables. Flying through this because I just want to level set us, and we're stacking these ideas on top of each other. We're like, okay, what do I want? What is the cash flow from distributions and the valuation that I want based on what I know, which is the owner's utility lens and the discounted cash flow? Then how do I track and measure all 4 of these KPIs, regardless of whether I want to sell or not? Because the whole point is if you know that your normalized EBITDA, I'm just going to make some numbers up here, is $2 million and you have a 7 multiple and you have 0 debt, then you know that you have a $14 million equity valuation. How much do you get at closing? How are the different ways that you would get that money is a whole nother conversation that we're going to unpack today. But these numbers can be knowable across all the different types of buyers and market valuations, and you can track this in your financials. But when we get to a specific buyer, each buyer will have a different deal structure of how you get that money and what's your risk, and like what are you having to be involved in long term. How does it impact your time through your job and involvement? How does it impact your cash flow, and how does it impact your wealth? And then how does that value get shuffled around through these different deal structures? And it's important, as I walk through the deal structures, then I'm going to explain, I'll just do it right here. So there's a lot of different deal structures, and I'm going to go through in each of these in depth, but each buyer group and type of buyer, like private equity versus ESOP versus internal buyout, etc., will lean towards certain ways or certain parts of the deal structure, and just being aware of what's common in each of these structures or each of these buyers, and then what kind of structures they lean on is going to be important for you, because the thing that we're going to want to focus in on is cash at closing. How do you get as much cash at closing? So when we take the enterprise value, which is that 2 times the 7, that's the enterprise value. You can get cash at closing. You might have to carry a seller's note. Escrow is where you put some money into a bank account for some promises that need to come to fruition. An earnout is like a bonus plan, and rolled equity is where you're putting equity into the future buyer. But before we go into each of those in detail, I think it's really important to level set us on the game of capitalism, really, because there's all these different ownership structures that are playing different flavors of the game of capitalism, and understanding the constraints and the thesis of each of these buyer groups and these ownership structures is going to be super important, because that allows you to match up your goals of what you want for the company, what kind of, how are they going to handle your employees, your legacy, how are they going to handle the trade-offs of cash at closing versus money over time. And I'm going to go through each of these, because each of these will have different nuances that come with them. So like an owner operator, that is a privately held person or business. Privately held, and then actually I'm going to say person / partner. So it's a single or set of partners who typically work at the business. So they also have that job. So they're going to play the role as a CEO, and they are doing this because they want freedom, just like you, over their job and wealth creation. So in this bucket, there's a lot of people called acquisition entrepreneurs, but if you think about all this spectrum, and I'll just quickly give you a bird's eye view. We have family office here, employee owned, private equity, venture capital, and public company. And there's a spectrum of ownership control where you have higher ownership control over here and you have lower ownership control over there. And each one of those options is going to have different mandates. Well, as an owner operator, if you think about you selling to your partners, having your key executive buy you out, or having a third-party person, which my friend Walker Diable, who wrote the book Buy Then Build, a lot of people are talking about these acquisition entrepreneurs nowadays. They're going to come in and they're going to buy the company, and it's really up to their goals, right? So it's very nuanced, and as you can probably learn from listening to me on my trainings or my podcast, very few people have clearly articulated what are their time, cash flow, and wealth goals, and in what timeline, and how's the company going to fit into that. So a lot of times people don't understand, and a lot of times people don't have any visibility, and they haven't articulated this. So you driving that process will be very important. But just know, there's a lot more control you have, because you could do partial buyouts, you could do a lot of it's going to be a combination of bank financing or seller financing. And I'm going to get into the different types of buyers in a little bit more nuance, but I'm just walking you through what are the constraints and how do they play the game? Well, it's very fluid, because a lot of people haven't articulated their goals, and it's going to be generally partners or people that are coming in to buy your company. And this is where it's the backbone of America's privately held businesses. And then we have this group called the family office, where it's a family who keeps the business and the estate to provide wealth and jobs for their family and community. So that's where if you were to actually step out of your operations and put your company into your estate, you would probably have a form of a family office. There are a lot of family offices that are extremely active in the marketplace because if they have a portfolio of assets, they might say, you know what, we want private equity. They want to go buy companies. So there's a family office here in town in Minnesota called the Opus family, and they got it. We're in commercial land development, real estate, got into banking, and they own a bunch of privately held companies. Paul Moffat has been on my show a couple times, and they buy companies to keep them in the family because they want to generate wealth and a return based on their overall portfolio. So the thing that comes with the family office is they have a lot more time because they're long holders. They're going to generally back management because they're trying to collect free cash flow and distribution. So their focus is that owner's utility lens, which is a free cash flow internal rate of return. And a lot of times there's a lot of good matching with legacy, et cetera, but there's a lot more fluidity as well. That's why it's over on the left end of the spectrum, because each family office might have different mandates and how they want to view and hold these assets. But a lot of times it's for the long haul, and they're willing to preserve the legacy and keep the cash flow machine going and back and reinvest into whatever's generating more of a return. Employee owned is a employee stock ownership plan. So that ESOP is a trust, and I actually will be breaking that down in a little bit more detail. And it's a way where the employees can get vested equity into the company for long-term wealth creation. So the purpose of the ESOP is to have long-term wealth creation for the employees. There's no timeline that they have to sell it by. The whole goal is long-term wealth creation and making sure that asset is generating more wealth. There's a lot more. You can't just go take out a $400,000 distribution to go buy a boat. There's a set of structure around the ESOP in order to make sure that the company's generating wealth, free cash flow, and reinvesting for more free cash flow for the benefit of the employees. So again, it's just really just a healthy company is what people want. Then there's private equity, and private equity is a series of professional investors investing in a company that they're targeting a 20 to 25% rate of return within 5 to 7 years. That timeline, now if you're tracking what I'm saying here, is like all of a sudden we have this constraint of a timeline. That's going to dictate certain behavior that may or may not fit you and your goals. But just knowing that this ownership structure, they're raising money from pension funds, endowments, large institutional investors, so that way they can buy a company, grow a company, and sell a company at a profit that generates this rate of return. And then they have to give the money back because my Aunt Stacy and Paula, who are teachers, need their $2,500 or $3,000 a month or whatever it is for their pension. So there's money owed at a point in time in the future. So everything that has to happen in the business is all about the first and foremost is getting that rate of return. And they're buying cash flowing companies. That's, I think, a really important note here. So those cash flowing companies, they're doing leveraged buyouts. They're using that cash and they're buying, call it 80% with debt and then equity, 20% equity. And that cash flow has to service that debt while reinvesting for growth within that designated timeline. Venture capital, on the other hand, is investing in ideas with a target rate of return of 30 to 40% within at a 10x their money with a 7 to 10 year window. It's, that's a lot of it's an idea. This could be the next unicorn. I mean, everything's a unicorn right now, but the whole point is it's going to have to generate cash. I mean, Amazon, it took a long time, but it proved that you can do that. You can burn cash to eventually have a monopoly in the marketplace. They're supposed to be rare, which is why they're supposed to be called unicorns. But so many people that I've come across over the decade, they confuse private equity and venture capital, where venture capital is the Silicon Valley. They're coming up with ideas and they're betting on ideas. Private equity is more traditional businesses that are around and that are generating cash flow, and they're going to use that cash flow to do a leverage buyout. But there's also a timeline, and most people listening in here are not going to be concerned with the venture capital and the public companies. It's just not, I mean, we're here because we have an operating cash flowing company. We're trying to figure out what the landscape of ownership looks like, the whole point of the expand knowledge module. And then public companies, I think we all have a good understanding of what they are, but their whole goal is to provide a dividend and internal rate of return for the shareholders. I mean, my favorite example is Michael Saylor, CEO and founder of Strategy. And he's always talking about he had $500 million of cash on his balance sheet in 2020. And he needed to figure out how to come up with a rate of return on that. Otherwise, he'd have to give his money back because his investors were like, okay, well, I might as well put it in the S&P 500 and get 11%. So all of these structures, ownership structures, are putting constraints over their desired cash flow, their desired equity creation, and in what timeline. That's going to put constraints and the pressure on the business. And this is why you have to do this, because if we do not, as owners, come up with our goals, then we're just floundering around and we have no lens around how do we make decisions of like whether we should take the money out for a lifestyle, whether we should reinvest, what's the return. So all of these companies are looking up at that build-up methodology, which is that if the build-up methodology, which I'll just pull it up real quick, this is from the owner's utility lens, which is this build-up methodology is how all of capitalism works. So we start with the risk-free rate, which is the 10-year treasury, T-bill, or not T-bill, 10-year treasury, because it's not a bill. Bills are 24 months or less, I think. That's 4.7%. And then we stack on risk. We say, okay, well, we can put in the S&P 500 and get another 6.9, which averages around 11% or so, 11 to 12%. Then we add privately held companies, which is more. All three of these are published each year. So every one of those investor classes of those ownership structures are saying, where should we put our money for what desired rate of return based on our investors' goals? So this drives all of capitalism and all of the pricing over all asset classes that have a cash flow statement, not commodities, because commodities like oil or gold or grain don't have a cash flow statement. It's just the price of a unit. Anything that's got a cash flow statement and is an investment will be judged based on the rate of return based on the risk of the future cash flow. Then we stack in industry risk premium. SaaS is different than manufacturing. And then we go to the company specific risk, which yields a return profile of a privately held company that could be very significant. So venture capital is going to be more over here. And then over here is going to be more private equity, which is you and or a PE firm. You just don't have a timeline that's dictated by a pension fund. So what we're trying to do when we look at the ownership structures is there's a specific internal rate of return that is judged based on all of these ownership structures. Over here, owner operator, it's whatever theirs is. Family office is whatever theirs is, but it's going to be more in line with patient capital and knowing that, hey, it might take a while to get this 20% IRR. It doesn't have to be done in 5 years and given to Ohio's teachers pension fund. Employees is for the employees, and that is based on long-term growth. So it's a longer view. Private equity is 5 to 7 years. It's now more on 10. Venture capital is, again, an idea, which means they have a higher risk profile. So you can see here that the timeline, the mandate over growth of equity and what in that timeline and the cash constraints of that. And public companies think about like a growth or a dividend stock, those will be something that you gravitate towards or not. And that's how all these investors are thinking about this. I bring this up because this is what I see as the most common way to view the landscape of all ownership structures. There's a lot of different buyers that will be in various buckets, and you understanding how the desired return and cash flow needs based on the ownership structures and characteristics will help you go, okay, I like that private equity firm, but maybe that timeline is going to maybe put mandates on my company and constraints on my company that don't align with my legacy. Could be a lot of money at closing. These are just things that you're going to have to weigh over. What do you want for your job and your time, and what do you want for the company and the legacy? And then what's it going to cost you? Right. And that's why understanding these valuations is so important, because then we can start to get to that answer in the strategic transaction value lens of what does it mean to you if you were to trade your equity or some of it with one of these types of buyers or ownership structures, and how does that impact what you want for you and the company? The more you have more control over the cash flow statement, the more percentage you have, and the less structure and professional ownership you have. So what that means is like, if you think about a cash flow statement, which I talk about in the owner's utility lens, everything that's below cash flow provided by operating activities is ownership's choice. How are we handling debt? How are we handling reinvestment? How are we handling taxes? And then what do we do with that cash? The less say you have over that, the less you're outsourcing that final outcome and the wealth creation to someone else. And are you matched up with your values, your goals and strategies with that person that's going to have more of a say? You can have more say over on this side of the ownership structure. You're outsourcing more of those final decisions to other people the more you go over to the right. Okay, so where does this all go? So each one of these ownership structures, and then I'll get into like very nuanced types of buyers, because I think there's different types of buyers, and I'm trying to just demystify a lot of the language that gets used in the marketplace, so you can go, oh, that's what the hell they were talking about, because Ryan said that this was this type of buyer, but they're backed by this ownership structure. Got it. What kind of deal structure are they presenting in front of me, and why? Well, a lot of that will mandate where they're getting their capital, what the return aspect is, and then what's that type of buyer. But before we jump into some of those other nuances, I think level setting us on how does a deal get paid and what do each of these deal structure components mean is going to be super important. I did an entire podcast with Dave Deal, who's the CEO of Prairie Capital Advisors, about this topic. I highly recommend, if you want to just jump right in and go and listen to that. That'll be another validating of everything that I'm saying from someone that's doing deals all the time. But the way that we can look at deal structures is we take a multiple. Well, first we would take the normalized EBITDA, which is earnings before interest, taxes, depreciation, and amortization, times that by the multiple. And let's say it's 2 million times 7 equals a $14 million enterprise value. First of all, that's not all your cash. You got debt, you got taxes, and then there's the deal structure. So the things that are going to, the thing to really concern yourself with is net proceeds, which is how much money goes into your bank. That nice little building, right? More proponent of Bitcoin. So anyways, we put all of our, how much money goes into our bank account after everything's said and done. So we have taxes that we have to concern ourselves with. We have debt payoff. And that debt payoff I talk about in the market valuation lens, which is net debt, which is you get to keep all your cash and you have to pay off all your debt. So it's a cash-free, debt-free company at closing. And then you have normalized working capital. You can go check that out if you want, but let's assume there's no debt here. So there's a $14 million, what I call the purchase price. Think about this like your house price or the list price. That does not mean that you get 14 million bucks, unfortunately. I learned this the hard way. We had an 8-figure sale. 8 figures did not go into our bank account, unfortunately. I'd hate to break it to myself and to everybody. So that enterprise value, then the question is, if this is $14 million, how are you getting that money? And what we could do here is we say, okay, well, we're going we're going to get $4 million in cash. Then, so cash is cash at closing. And so the way, if you think about it from a buyer's perspective, so like I think the easiest way to think about this is from the lens of a buyer. You're going to go in and you're going to buy a $14 million company. You're going to have to provide equity and debt at closing. In the big buyers, the more you go to the right, the more access they have to capital, which is equity and debt. The more equity you have down, the less the monthly payment. It's just like a house. So if you have a 20% to 80% debt to equity, they have to finance a bunch more. So even though you might be getting cash at closing, it might be coming in the form like if I went out and took out a $10 million loan, I have cash and I can give it to you. It doesn't mean I have to, like, the point is the business will have a certain debt load after the deal. The company has to be able to finance and service that debt and that interest. Interest rates are now hovering around 11% on big, on company buyouts. They used to be 4%. So the cost of capital is now higher. But let me not make sure I don't lose my train of thought. So that cash at closing is going to come from the buyer's ability to provide debt and equity at closing. So like if let's say I went and bought a house for $1 million, that doesn't mean I have $1 million. I'm bringing 200 grand. I might have 800 grand in debt, but the seller still got all cash at closing. So the ability to get capital, debt and equity is going to be a big proponent on all the buyers. So regardless of what buyer type you are, it's their access to capital that's going to be a huge proponent of this, because let's say the company can't service the debt because we have lumpy cash flow. Well, we're going to have to put more equity down. The more equity we have down, that erodes the rate of return. Because if you think about it like this, if you were to buy a house, you're not going to most likely pay all cash, because you're like, in my example I gave, you're like, well, I might as well put that $800,000 into the S&P 500 and make 11%. My house only goes up at 5%. So by putting all equity into a house, you're locking in that 5%. So what a private equity firm does, or a lot of other buyers, they're going to have to purchase the business from you. So most people are not going to use all cash. They're going to have a strong proponent they're going to be a strong proponent of debt at closing. And whether that's 50% cash, 50% debt, or 50% cash equity, 50% debt, is all depending on their investor mix and where they're getting their money. Family office will have more access to cash often. Smaller owner operators will have, to rely on SBA loans or conventional bank financing. And so that cash, we want to maximize your ability to get as much cash at closing. So that way, when you're on the hook, we want to know that you don't need it. Because if you're outsourcing final decision making, whether it's an ESOP, private equity firm, third-party buyer, whoever it is, the more you're outsourcing your decision making and authority, the more we want to get cash at closing. Because what I want for everybody is this escape velocity, which is, that your cash at closing, ideally, and this is an ideal world, you're financially free. I know that's not possible for everybody, but like the more we can be disciplined to make sure that we've got the right cash flow from our necessary sources, and that our net worth is we're going to be independently fine and financially free at the cash at closing. I literally think that is the definition of escape velocity. Whether you own the company or keep the company, you have the ability to be fine. So that cash at closing we want to maximize, especially the more we have a majority buyout to someone else. Then what happens is if a buyer does not have the ability to have access to capital that meets that $14 million, and just follow me here because I'm making stuff up as I go, they're going to push that risk back onto the seller. and you're going to have to carry it in various different vehicles that have different risk levels. So a seller's note is literally where you're the bank, just like a contract for deed with a house. So that seller's note is usually, especially if the buyer's got a senior lender that they use to fund part of the buyout, it's going to be subordinate, and it's going to be the note plus interest. And it's usually interest only until the senior bank is paid out. Depends a lot, but I'm just walking you through the spectrum of options. So let's say you get let's see, if we got 10 million left. So $2.5 million. These numbers are going to be off as a typical, but you'll have to bear with me as I walk through the examples. So let's say you carry 2.5 million bucks. Well, then we have escrow. And the point of this, the seller's note is because that reduces the need to go get the money from a bank or from equity. So you're participating in the cap structure and the capital stack and making sure that the buyout still happens. Escrow is a promise. They call it reps and warranties. So you're representing and you're warranting the promises that you made. So rep and warranty. And what we do is we say, okay, well, you know what? You told me that you're going to land that big contract and it's not here yet. So I'm going to put, let's say this is where it's probably not, well, I know it's not typical to have $2.5 million in escrow, and that's, call it 12 to 24 months. And that's based on promises that you gave a rep and warranty on, making sure that there was no environmental issues that came back. Maybe there's employment issue, whatever the risks are. It's a way of saying, okay, we believe you, but we're going to park $2.5 million into an escrow bank account that's going to be managed by a third party. And we're going to have say on like whether you get that money or we have a clawback. There's a lot of games that go on with that. And that's usually not that large of the purchase price, but I'm just going to show you how we can allocate $14 million into a lot of different buckets. The earnout, I like to think about the earnout like a bonus. And that bonus structure is based on KPIs that are agreed upon hitting. So it's another way of kind of getting that escrow promise. It's different, but it's got a completely different structure, but it's kind of accomplishing the same thing, which is we're not sure about you maintaining this customer base. Like we want to make sure that these customers stay or these employees stay, or that we actually go from 15% to 20% of revenue of this one business line. We want you, seller, to stay on board to make sure that that happens. And if that happens, we're going to give you another 2.5 million bucks. So again, if you think about it, all of the seller's note, the escrow, and the earnout are mechanisms that allow the buyer to not have to bring that capital to the closing. So that earnout is really like the reason I think it's like a bonus. It's like you would have had to do this stuff anyways. I have so many podcasts about bad earnouts. A guy named Bobby Martin, he sold his company and they had, I don't know if it was like 20 sales reps or irrelevant, but all of a sudden all the sales reps got 15 more product lines that they had to sell. And now they were distracted and he couldn't hit his KPIs. So there's a huge gotcha of making sure it's a KPI that like revenue, not normalized EBITDA and not net income, because you no longer control most likely you won't control the cash flow. So, I mean, I have worked with people where like they were getting dump trucks jammed into their division because it was a way of doing accounting and tax planning, but then that expense hit their earnout and inability to get their earnout. We just want to make sure that you can control the resources and the ability to actually hit that earnout because you've got that $2.5 million on the line. And once the deal is done and you no longer have control, a lot of shit goes south really fast if you don't trust the person. And if all these mechanisms are legit, but they can be used in very malicious ways because of the asymmetry of information, because a lot of people don't know what we're talking about here. So then they get taken advantage of, where they think they're going to have a $14 million sale. Through due diligence, it dwindles down and they realize they're only getting $4 million of cash at the closing. Like, I should have just kept the freaking company. So the earnout is something to be aware of. And then the rolled equity is really where you're taking part of your proceeds and rolling it into new entity. In private equity firms, it's usually the platform buyer. You're not getting part of the private equity firm. A lot of times strategic buyers, and this is why I'm going to break down the different types of buyers and what they normally do. A strategic buyer won't generally want you to have equity in their company. Rolled equity is where you have a piece of the second bite of the apple, where, hey, you're going to take $2.5 million of your proceeds, and we're mandating that you're going to roll it back in, because we know that you're a linchpin as part of the operations. You got so much not tribal knowledge. You've got like all of the reasons that you're coupled to the business, which is why we're working on all this stuff, is what's going to be the clause that come into you where you're carrying all the risks without having full control over the company, which is a bullshit deal. Unless you architect it for the exact reasons that you want based on your owner's goals, then I'm totally for it, because you go in eyes wide open. But if you check this out, we have $4 million cash at closing on a $14 million sale. Hypothetically, this is all hypothetical, but I just want to show you, like, it's not it's not clean and clear. Like, hey, I got 14 million bucks. I mean, that's why, like, every panel or every podcast or any story I hear where someone says they sold their company for 30 million bucks, like, how many partners did you have? How much debt did you have? How much cash did you get at closing? What were the hooks that were like put onto you after the sale? No one wants to talk about that. After 10 years of a podcast, I realized, a few years in, so many people weren't telling the full story, because they're like, well, I've still got rolled equity, I've still got a seller's note, and I effing hate the buyer, but I have no choice. And I'm pretending it's all hunky dory so that way I can get a consulting gig doing other things. It's a huge disservice to everybody when we need to know that this is how it works. And there's a lot of games that can be played. All of these tools and strategies have a very specific use case. And I'm not saying that they're not appropriate for the right reasons, but when they're used for the wrong reasons to bamboozle an owner who has never done this before, pisses me the hell off. And so we just want to level the playing field, so that way someone can say, yeah, I want this at closing, but to get a deal done, I'm willing to, carry some of the note, and we can have a little bit in the earnout, and everybody goes, oh, great. How are we going to manage this? And we're just focusing on aligning those incentives and the goals and the strategies, instead of going in with, blinders on, hoping that we just get a bunch of money, which is just not usually the case. So these different deal structures are going to be in play a lot of the time. The bigger the company, the more creative you can get with deal structures. And I'm going to walk through brokers versus investment bankers, but and there's a lot to be said about the smaller end of the smaller end of the spectrum. We're going to be dealing with a lot of SBA loans. So anything underneath a $5 million purchase price. So here's an interesting rule of thumb. So a $5 million purchase price, enterprise value, EV. If you took out an SBA loan, and you can check my math on this, but it's roughly right because it's been a while since I looked at it, but a $5 million SBA loan at 10% over 10 years. So that's on a full buyout. Usually have like 10% seller's note. That's 70 grand per month in debt service. The seller gets all cash at closing. It's a full buyout, but that buyer is saddled with debt, and they have very little cash flow to reinvest into that company. So you get over to the smaller end of the spectrum of these owner operators, and they're going to have to use, because a lot of times they don't have their own cash. Like if they had a couple $1 million in cash, go put it in Bitcoin or the S&P 500 and get your 11 to 30% and be done. So it's this paradox where, like, the people with all the money want to hover up at the top, but the people without the money have to be at the bottom because they want to create wealth, but they have to rely on bank financing. But then the company's cash flows can't actually service 70 grand a month. It's like, oh shit, now what do we do? That's where you have to get creative on the lower end of the spectrum, where it's like, okay, are there partial buyouts? Siri's listening. Are there partial buyouts where there's some seller? That's where we get into this creative deal structures where do we have a partial buyout, which gets some cash at closing for the seller? Do we carry more on the seller's financing? Do I keep some equity? Because it's all about that monthly payment. It's all about the monthly payment, and can the free cash flow distributions service that payment? Which is why I think we need to look at owner's utility lens. Like, how much cash flow do I want out of the distributions? Oh, by the way, that's what's going to be available for servicing debt. There's someone who'll put some equity down, but I can actually guarantee that I can service this debt because I can guarantee that I've been taking those distributions. Hopefully you're starting to see a lot of these connections. I know I'm jumping around, but I'm trying to just constantly provide rules of thumb on how to think about all this stuff. So on the lower end of the spectrum, you're hampered by a lack of desire for equity and capital markets to go to you, because it's not as interesting, because it's better to, the cost of capital is the S&P 500. Say, well, I can always put it in an S&P 500 index fund and get 11%. So I need to get more. Well, I don't want to, the more money you have, the less you want a job. So then we have to have someone that actually does the job too. So that's why we want to decouple our job from the company. And then that will allow us to, some really cool examples of, like, the more we can do everything that I talk about in the owner's playbook, decouple our job, put a system in place, have predictable cash flows, we can go to any buyer with those 4 KPIs and say, here's what the company's worth. I want as much cash at closing as possible because I've proven that I'll be able to take these distributions out. But if you know that you're going to get your financial freedom number cash at closing, and let's say that $4 million hit your target, and you want to get a deal done, it's the right buyer, and you feel really good about it, and like you feel like they're going to take it to the next level, you're taking a risk, but like you know that this is a calculated risk with these 4 different buyout structures, to say, hey, I'm taking a calculated risk, and at any given point, I can go, no thanks, I want no involvement in this. And if the thing burns to the ground, you're like, that sucks, but I gave it my best shot. And you're not taking multiple steps back on your wealth and your independence escape velocity. So we're just trying to always get that momentum of decoupling your job, having to be able to prove the value based on the normalized EBITDA and the multiple to get as much cash at closing. So then you can do whatever you want, essentially. And then we have a lot of options on how to match up your eventual sale or the buyer with your goals. So before, I'm trying to think if there's anything else I missed on here. If you have any questions, drop it in the YouTube comments or shoot me a LinkedIn. I love talking about this stuff, as you can see. So I've alluded to a little bit this net proceeds. This net proceeds is money that goes into your bank account. I mentioned enterprise value, which is the list price. Then we have equity value, which we have to pay off our debt. We get to keep our cash. And then we have to provide a normal level of AR, AP, and inventory at closing. That equals our equity value. And I have a whole case study where I walk through the equity value of 2 different companies in the market valuation lens video. And then we have taxes. This sucks. The taxes come out of your enterprise value. Understanding how the deal structure is going to impact your taxes and how much money comes in your bank account and when is going to be so important for you. And none of this is about selling the business right now. It's about understanding the game of M&A and capitalism, because how are we supposed to know what we should be doing, and what should we chase a deal? Should we not chase a deal? I got an out of the blue offer. Okay. What does that mean to me? Should I take this or not? I mean, we should know at any given point what our company's worth in the marketplace based on the 4 KPIs and what's it worth to us because of our sanity and our lifestyle and our cash flow. But if we sell the business, how much would go into my bank account based on the enterprise value? Let's say it's 14 million. Then we go down to the equity value, and then we go down to net proceeds after taxes. I'm going to walk through the biggest decision about taxes as it relates to deal structures. I did a podcast, I think it's episode 402 with Roger Roundy. There's a lot of ways that most CPAs, because they're just paying attention to tax returns and to quality of earnings and audits, and the risk adverse for very legit reasons, they don't promote things that are very like legal and legit on ways to mitigate your taxes by up to 40%. I've seen people wipe out a good chunk of their taxes, which helps increase the chances that you get your net proceeds target, because we want that at closing number to be as close to your freedom, the IBD number, that equals that whole time, cash flow, and wealth dynamic as possible. And so that just mitigating some of those taxes, which is, can be upwards of, we paid 53% in taxes on the sale of our 8-figure deal. And I'm going to walk through why. But by mitigating that, we can increase the net proceeds while decreasing the need to inflate the purchase price. Because this is where the odds are, the buyers and sellers are coming at this. Like the seller's going, I need to make sure that I'm retired at least to make this whole thing worth it. Buyer needs to make a good deal. And so there's only a few levers: the normalized EBITDA, the multiple, and then the deal structure to make sure that that buyout works so they can actually hit their goals after they buy the company. And taxes become a bridge that can help with that along with the deal structure. So the biggest decision that any deal has to make is an asset sale versus a stock sale. So if there's a rule of thumb worth remembering, buyers want to buy assets and sellers want to sell stock. There's a lot of reasons behind this. So this is why this tension exists right at the forefront, because neither of these people want the same thing. There's different rules, and they've changed over years as I've done this, that are different. It's called the 338H10 that used to exist to help match, bridge the gap behind this. But here's why this is happening at the highest level. So the buyer is buying the assets of the company, not the EIN number. So what I'm showing here is that if this is the EIN number of the buyer, they're going to come over here and say, okay, I want to take this stuff from your company, and then I want to put that in my EIN number. So what we're doing is they're avoiding all of the gotchas. That can be environmental issues. It could be employment issues. It could be all these different problems that they're avoiding by just buying the assets of the company and putting them into their EIN number. Couple things that happen. So one is the liability mitigation is a huge deal, but the second one, which is very important, which is for tax purposes, they can depreciate an asset sale, an asset purchase. So they can actually put it on their balance sheet and depreciate it. So it's organized into a lot of different categories I'm going to walk through. But a stock sale does not get that benefit. And so the stock sale doesn't have either of these benefits, which is a big problem in the lower market, because I think the last stat that I saw is 90% of lower market deals are asset sales. And there's a couple of driving factors of that I'm going to walk through, but a couple of things to note is what the ramifications of this. If you have contracts, you have to reassign those contracts. So if you have customers that you're concerned about leaving, like you have to reassign everything. People are getting underneath a new payroll. You have all the contracts that are tied to your EIN number I mean, this is a big problem for women-owned businesses, to be honest, because all of a sudden a new buyer is not a woman-owned business and there might be governmental contracts. I mean, that regardless, thinking about this is important because we want to get, I think the goal for everybody should be is get your company big enough where you can have as many creative deal structures as possible while hitting your net proceeds at closing, proving that you don't need to be involved in the business, and then being able to hire an investment banker instead of a broker, as well as being able to do a stock sale. And so I'm going to quickly walk through then the stock sale, and then I'm going to walk through the assets. Well, I'll do this first. So the asset sale allocation. So if you took that $14 million purchase price, it has to be allocated amongst all of these different areas. And this has to be agreed on both the buyer and the seller. And the challenge here is that each one of these has different tax structures. So the seller on fixed assets has a recapture gain. So depreciation, it's called depreciation recapture, and it's ordinary income. A non-compete, if you're getting like that was a huge part of our deal structure. Look at this, it was ordinary income. So we want to make sure that like that $14 million, and again, if you're a professional services firm, it's going to be very difficult because they will flag by the IRS. You can't jam a bunch of that purchase price into inventory because you don't probably have any. Accounts receivable, ordinary income. So you just look at, if it's all goodwill. So like I've done a bunch of work in the e-commerce space or professional services where there's a lot of goodwill. It's capital gains. So in this instance, goodwill, if you know that most of your 14 million bucks will be in goodwill, it might not be, it's not as big of a deal. As long as you're looking at the contract assignability and some of the other operational nuances that are going to happen when you transfer over those assets. But this is all stuff to think about because there's going to be major tension between the two right off the bat. And 95% of the lower market is asset sales. The stock sale is the opposite because what we've got going on with the stock sales, we have the entity over here and they're buying the whole entity. So the whole entity is going with, so they're whether they're a C Corp and they're buying an entity or somehow the buyer's buying the whole entity. So the things that come with that is all of the liabilities and and there's no tax benefit. There is something called the 338H10 election. It's been years, so full disclosure, it's been years since I have dove into this a bunch, but that allowed actually someone to purchase a stock sale and then check a box to this election that allowed some of the tax benefits. I'm not a tax advisor, but I know that those are just the questions. Like if you're talking to an M&A attorney or an investment banker, like, hey, is this a possibility? This would have saved, I interviewed Todd Ganos. This would have saved my dad and I 1.8 million bucks. Yep. Had we done this at the time of our sale. So, okay. What else does this impact? So there's a difference between brokers and investment bankers. There is a huge difference between the two. And the way I like to think about the market of brokers versus investment bankers is a Venn diagram. There's some people that are in the middle, and God bless their souls because they have a hard time differentiating themselves between the two because, if this is investment bankers and this is brokers, they're really doing a lot of the investment banking type of work, but they might be classified as a broker. It's just a lot to know about. That's why understanding what I'm going to talk about is important. Also, Peter Learman, the founder of Axial, which is an M&A website. He's been on my podcast and we broke down in great detail the difference between brokers, investment bankers, how they charge, their fee structure, whether they do upfront fees, long-term fees, not, but I'm going to just walk through some of the highest level stuff here. So brokers are on the lower market. Again, I'm going to piss off some brokers here, but like they are usually hovering $10 million enterprise value and below. Some of them will go higher and they'll claim that they do some of this stuff, but I'm going to walk you through what good looks like and then they can prove it. So it's mainly going to be an asset sale. And the reason behind that is because they have a commercial real estate license. It's asset heavy on the real estate because banks like real estate and they like collateral. So it's like, hey, the business plus the, I'm going to buy a liquor store. Well, the building's included. Well, the building is actually worth more than the liquor store. So sorry, my dog is being very loud. Jack, stop. So they are going to run a real estate similar process. It is based on listings. If you ever looked at Sunbelt Business Brokers is one of the largest brokerage firms in the country. They literally, like, you go to the website if you're a business buyer or it's biz buy sell and you're scouring through companies to buy, and you're like, that's what you're doing. So it's a list sale. So it's all about their email list and their exposure to buyers. They can't do, so they're doing asset sales because of this, whereas an investment banker is going to be regulated by FINRA and the SEC because they're dealing with stocks. Stocks and securities. That's why they can do all these creative deal structures and they can do stock sales because they're dealing with securities, ESOP, private equity, the larger companies. That's you're going to, the bigger the company. So a couple of rules of thumb here too is over here, you're looking at usually 2 million in normalized EBITDA and above. And over here, it's below 2 million. So the big problem with this is the backbone of America and the people I work with, call it your, I don't know, let's say it's $1 million in normalized EBITDA to even 10 million in normalized EBITDA, you're in the 1% of companies. So a lot of times, you're hovering in the, I call it the no man's land. So 500 to 2 million in normalized EBITDA, you're in no man's land. And the goal is to find this person that you're interesting enough to an investment banker type person that's running an investment banking process versus a broker. And there's a couple other things. And why is that I say that? So this over here, we talked about the email list is their primary driver and it's listings. Over on this side, what we have is they run what is called a controlled auction. So a controlled auction is where they literally have a funnel of buyers. So this funnel of buyers is going to get you one company that you're willing to purchase. So they have an entire process to say, okay, what is the world of private equity firms, strategics, and then family offices that would like to buy this company? They send out teasers. They have meetings. They come up with a list of 20 NDAs and then 5 potential offers. And then you go into due diligence with one exclusive buyer. They are managing this situation and they're managing this entire funnel. And they're also going to be very diligent on making, the level of service is just, it's hard to describe the difference. Super knowledgeable on deal structures, super knowledgeable on the world of private equity and all the more sophisticated buyers. A lot of times they have like Prairie Capital Advisors and Butcher Joseph. They do ESOPs as well as private equity, as well as third-party sales, as well as management buyouts. So they have the whole spectrum. And so you're just going to get way better service. They're going to build they'll actually, everybody will say this stuff. And the question for you is like, tell them to prove it. Prove how you do this. The due diligence library is a library. It's a data room of everything that you've ever done for all the contracts, all the report, everything is in a data room. They'll manage that. They'll make sure that the financials are packaged up in a way that they feel good representing. They will build a marketing. It's called a SIM, which is a confidential information memorandum, which is like your strategic plan plus the financials, which is like it's the pitch deck versus a listing. And again, I don't mean to be little brokers because there's a space for them. It's just, it makes my heart bleed when I find out that a $15 million company got put on a freaking website. It's like, okay, so this is a general market problem because I've watched inflation hit where now inflation is hitting the investment banking world where they are going upstream to this $2 million and going higher. So they're going up in normalized EBITDA, up in enterprise value, like minimums that they have to have because inflation's hitting. So, I got the investment bankers down here. Hopefully this is providing some light. The buyers, like the more sophisticated buyers, we're going to want to work through investment bankers. And then you go lower into the marketplace and you have brokers. And what I think is also important noting is this is a lot to do with third-party sales. If you're working with a partnership buyout or something with your management team, you could probably, depending on the M&A attorney or the advisor team that you've got in front of you, get a deal done without having to pay a very large fee, because the fee base for both of these two. So a broker will charge anywhere between 5 and 10% of enterprise value. An investment banker will charge 2 to 5% of enterprise value. And a lot of times the investment bankers will have a sliding scale because the higher, it's 4% up until the first 10 million bucks. And then 10 to 20, it's 2%. Like there's a sliding scale. There's a term for it. I can't remember what it is. But a broker, a lot of times I see them hover up on that top end of the spectrum, which is significant. If you got a $5 million sale and they're taking 10%, that's $500,000 for putting a listing on it. It's a lot of problems. The inefficiencies in the lower market is very real because buyers don't understand shit because they don't understand how to get the capital. They're dealing with banks who are a pain in the ass. And then you have sellers who have completely unrealistic expectations of the value of the company, and the company can't cash flow the debt. So poor brokers too, because they're just dealing with a bunch of headaches that I have no desire to deal with. And then everybody over here go, oh, this is great because there's a lot of room and capital for good advice, but there's not that many companies up on that size. The whole goal is that we're growing the value of the company while we own it, so we have more options because we want to be able to hire those people when and how we'd ever decide to sell. If we get if we get a out of the blue offer, there's a couple different ways to think about this. This is the process of taking a company to market from the investment banking perspective. And the reason I have this out there is because this is what good looks like. So it's taking this funnel right here. And what we're doing is saying, okay, well, what does that actually look like? So if you take the timeline's 4.5 to 10 months, it's pretty typical. And there's a lot of work that has to go into it. Here's my suggestion for an out of the blue offer. This happens at industry trade associations. You're hanging out with your buddies and someone's like, hey, someone would like to get into your state, or, they want a new product or service line. Next thing you know, the deal train has left the station and you're not in control of anything. what I have loved as, oh my God, I've got so many good examples from the podcast and people I've worked with. Understanding the 4 KPIs will know, okay, is this a premium? So if you look at the out of the blue offer, the first thing you would say is, out of the 4 KPIs, is this a premium? Or is this the type of buyer that matches your culture? And do they have the ability for cash at closing? Those would be my first questions. And then I'd say, okay, well, let's say you came and offered me, an out of the blue offer of 14 million bucks. I'd say that sounds great. But if I have decided to sell the company, which is what I'm now making this decision, I'm going off my current path to say, now I guess it's time to sell the company. Best of luck to you. I'm going to be hiring a banker and doing a process, and I hope that you win because I really like you. So many people don't do this because they're like, oh my God, someone finally wants to buy my company. It's 14 million bucks. This is life-changing money. But they don't know the company is actually worth 20. It's like, well, based on the 4 KPIs, it could be worth 20. And what if a strategic buyer is willing to give you 25? And I've seen that over and over and over again. Adam Webb has been on my podcast. Adam Webb, God bless his soul. He is an investment banker that plays in this part of the marketplace. Quasar Capital, full endorsement on my end. I love the guy, and he's a boutique shop that does that. And he has told me so many stories about getting like 30% more because they ran a process. Sometimes that out of the blue offer still ends up buying the company. But the process that we would want someone to go through is this organization phase where an investment banker will like go in and get their hands and head wrapped around the whole company. They'll start working on the data room. They'll start working on the confidential information memorandum. They'll start working on the gathering of the list of people. Then they do the marketing, which is they're going out. I mean, they have a CRM of buyers, of private equity firms, family offices, and strategics, and they're gonna then start marketing it to get the first indications of interest. Then there's a due diligence process, usually with an exclusivity, saying, okay, well, like back to this funnel. We got so many NDAs. We had some meetings. We want to, go through with this person. There's a solicited detailed bids. So like, again, these are all kind of nuanced ways of putting this, but that due diligence could be on, a certain site, middle of the funnel of the buyers to get specific bids where you're actually going to draft the agreement and related documents. And then there's the final negotiation. An investment banking firm will handle all of this, and it's a full-time job. I got 4 people out of my group right now that are selling, and it is a shitload of work while you're trying to run the company, not keep the eye off the ball, because everything will erode the purchase price and the deal structure. Nothing goes up after, call it this. So you want to have all of your ducks in a row. So that way, as you continue to go, you're holding the line on that value and that deal structure, knowing what you want. So like I got a client right now, it's like, okay, I know that I want, call it 5 million bucks or 10 million bucks at closing after tax and everything. Okay, well, that knowing that the fair market enterprise value is 30, well, okay, the purchase price has to be around 20-ish, because let's say you got partners and debt and taxes. Like, okay, great. Now I've got flexibility on rolled equity or seller's note, et cetera. You have more flexibility, but you go in and say that to the investment banker, like, I need $5 million cash after tax and debt and fees at closing. Okay, that's my non-negotiable. So now we have something to work with in layering on that deal structure and then the different types of buyers. And okay, we know this, so that way throughout this entire process, your non-negotiables are front and center for that investment banker. Like, not closing this until I get that. And I know that I get that. And the benefit of this is I had a guy, his tombstone's back there. $50 million was his purchase price, enterprise value. And he knew back of the napkin math of like, more than back of the napkin, but like exactly how much that meant for him compared to his family members, debt, taxes, all this stuff. Said this to the private equity firm, gave him an NDA, gave him the financial model, gave him the data room. So like, cause he'd been working on this stuff for years. It's like 50 million. Otherwise I'm not talking to you. It was a PE backed strategic buyer. PE firm gets into town. Like, like I've been thinking, he said, get out of my car, get the F out of my car. This is my number. Okay, is what he heard. And he ended up selling it for exactly what he wanted because he knew the market valuation, the 4 KPIs. He could turn around and do an ESOP, he could turn around to anybody else, and he wasn't willing to dick around if he didn't get what he wanted. And this process, being able to articulate that to any out of the blue offer and to the investment banker, allows that non-negotiable to be carried throughout the entire situation, whether it's your non-negotiables on the purchase price and the deal structure, what you want with your employees and your culture, all of that stuff is just thought through. And that's just different than putting your company for a lens or putting your company on a listing for a sale. So we covered asset versus stock sale, net proceeds, taxes, deal structure. What I want to do next is there's different buyer names that you'll hear, but this needs to be weighed. It nests underneath the ownership structure. So all these buyer types are going to have different ownership structures because you could have a strategic buyer that's backed by private equity. That's going to impact the timeline. Then you have just another company that could be privately owned. We sold to a privately held family that their goals of cash flow and wealth were their goals, whether they clarified them or not. So a strategic buyer, then there's private equity in the traditional sense with the, call it 5 to 10 year turnaround. ESOP is the employees. And then there's this acquisition entrepreneur, which my friend who wrote Buy, Then Build, Walker Dybel, they are usually corporate refugees. They are, call it like the person I live in Minnesota, like a 3M person that ran a division of 3M for like, they had a $50 million division. They want to go use their 401k and some cash to go and an SBA loan to go buy a company. There's a lot of family office money that's now backing acquisition entrepreneurs who want the job of the CEO and equity and upside. They're gonna generally be using bank debt and equity. And then you have partnership or management buyouts, which is your partner or key executives. So there's some nuances of each of these that I think are worth noting. Is strategic buyers' reliance on the market valuation. And I say market valuation because how much reliance do we have on the sustainability of the cash flow to be able to service debt? That's essentially what we're talking about. And I say low here because a strategic buyer, like when we sold, we gutted the company. So we like increased the cash flow of that company because we bolted on the customers and the skeleton crew on top of their organization. So they're not going to be relying on the operations as it stands today to service that debt. Reliance on the job and the operator is low because a lot of times strategic buyers will have an executive team. So they're bolting you on and there's a lot of back office synergies behind that. But then your control over future ownership decisions is going to be very low. And your ability to get more cash at closing is very high. So if legacy is a huge important thing for you and you want to make sure that you've got a lot of your fingerprints all over the future direction of the company and maybe more say, this might not be the right route. But if you wanted to accelerate your timeline to get out of the business, this is a good way to do it. That's what happened with my father and I. I went home and I cried because we fired 60 employees and my legacy got gutted. This is just the trade-off over cash versus the actual intrinsic or intangible things that you want. Nice little kid interruption there. So where was I? So the private equity firms, I'll just move on to that now. Private equity firms' reliance on the market valuation is high. I say that because they're going to be using the cash flow of the company to do a leveraged buyout to put debt on it. They might be a strategic buyer where that there's a platform company that ends up, so there's another company in your industry, but that they're backed by private equity. As you can see, the ownership structure, the mandates of cash flow, equity growth, and in what timeline, you can back into it, go, okay, well, who owns this company? Oh, that's the mandate that they're going to be coming at this from. Do my culture, my company, the strategic plan match up with what I think is driving the incentives. This is of all the way from the top down. You have if you can prove your cash flow valuation, that market valuation, those 4 KPIs, you'll be able to strongly argue and defend your valuation. Your reliance on the reliance on your owner operator job, that CEO, is medium, because a lot of times they're coming in with more executive resources. So they might have their own C-level suite that they're coming at this from. There might be a lot of other resources that bringing it in that could decouple you from the company, but it's not a guarantee. The more you decouple yourself from the job, the more options you're going to have. Control over future ownership decisions is medium. You might have some say in the depending on the PE firm. This is where it depends, but there's going to be someone else that owns the company at the end of the day. The ESOP, there's a high reliance on the market valuation, those 4 KPIs, and being able to fund that debt with the cash flow from the company. You have to work yourself out of a job. It's an ownership buyout. There's no change in the operations day 2. So if you hate your company, hate your employees, and you don't like your job, day 2, it's going to be the same company. But if you love it, that's a great thing. Control over future ownership decisions, medium. You're going to have, I would say it's medium to high, because you're going to have a lot of say in the operations. The trustee who manages the company, and I'm going to do a whole ESOP video as well, is not going to come in and help you operate the business. You just can't pull out distributions whenever you want, because it's, you have either your partial ownership of an ESOP or a full ownership, and it's for the benefit of the employees. So it's no longer your company, but you have a lot of say over the strategic direction of the business, as long as it makes sense. Like if you're a SaaS company and all of a sudden you're buying plastic straws in California, they're going to be like, what the hell are you doing? But other than that, or if it gets into major financial distress, there could be some workaround or workout situations, but a lot of flexibility. Acquisition entrepreneur, they're going to have a high reliance on that cash flow buyout, because it's going to be generally funded by debt, and it's a medium for the reliance on that owner operator job, because most times that acquisition entrepreneur wants to come in and buy the equity and the job at the same time. So this becomes a very, very interesting and important buyer in this mix, because a lot of times people don't have the energy or the timeline to work themselves out of the job. That's why I want to work with people way before that, because it's like, let's get you out of the job so you have as many choices as you possibly can have. You have medium control, because depending on the percentage of the buyout. I mean, if 100%, you don't have any control. If you have partial, you might have some stake in some say in it, but a lot of times it's the majority buy, which means you're reducing your control over the ownership decisions. Management or partnership buyout, it's high on all of these, because you have to fund the buyout with the debt, whether it's seller's note or the bank debt. You're going to have a high reliance on your job, because someone's going to have to do your job if you step back, but you also have a high flexibility of organizing this however you want. Less chance of all cash at closing, unless it's an SBA banked buyout. And you're going to have a higher control over what kind of decisions you have in the future based on what percentage you decide to sell. The reason I'm bringing all this stuff up is I know what people care about is options. If you have less options, you're going to have to move more towards this strategic buyer, and you're going to hopefully get all those cost synergies and accelerate your timeline and hit your number. But the more you care about your legacy, your culture, your employees, like everything that you've built, the more you're going to want to focus on those 4 KPIs from the market valuation lens. So you can look at all of these buyers and say, okay, how do all these buyers look at the company? And then what kind of deal structure do they have? The one thing that I think is worth noting, so strategic buyer, more cash at closing. It's going to be a large percentage of that. Private equity, call it, I don't know, 50 to 80 or 50 to 90%. It's a lot more rolled equity, a lot more seller's notes these days because of the cost of debt. ESOP, you're going to get 50% at closing, and then 50% in note plus warrants, which is kind of like rolled equity. Acquisition entrepreneur, you could get, I'm hoping that if someone is coming in, they have the bank debt and the equity. So hopefully it's going to be 90+%. And then partnership management buyouts is totally to be determined based on your partner's access to equity and debt and the company's fundability and how much it can fund. The more you can prove the future cash flow of the company, the more options you're going to have, the more you're going to like your business. I'm not going to go through these two videos right now, or I was going to go through this, but it's getting a little bit long already. I'm going to have a couple videos where I break down private equity and ESOPs. Buyer characteristics, this is in the PDF below. Again, given the time already. I just created a list of all these different buyer characteristics of reliance on cash flow valuation, high, medium, low. And these are all rules of thumb. So like, this is not a prescription. This is a set of guidance. Probability of maximizing enterprise value, specific deal criteria, ability to maximize intellectual property value. I mean, I'm just going through a lot of different characteristics. And then what's the chances of those things happening based on owner operator, family office, ESOP, acquisition entrepreneur, private equity, or strategic buyer. All of these can have different ownership structures that I think are important to know. That's going to dictate the timeline. So everybody in capitalism that plays the game of ownership is governed by these rules of what kind of cash flow do the ownership team want for distributions, and what's the equity valuation target in the timeline. An ESOP is infinite. A family office is usually way long. Owner operators, it all depends on whether they've clarified their freaking goals or not. Private equity firms, it's 5 to 7 years. Venture capital and public companies are not part of this. You're probably not watching this if you're in that marketplace. So it's all about goal matching, right? Like, what does this company mean to you for your cash flow, time, and wealth? What are the 4 KPIs, and how would those 4 KPIs be valued under an ESOP, valued under a private equity sale, management buyout? Like, what's the market value of this, regardless of the buyer? Then, based on the specific buyer, how does that deal structure accomplish my goals? I really want you to have this number checked at closing. So in this example, if someone wanted to go from 50 hours in the business to 20 working hours in the business, and you have a cash flow goal of going from 200 to 500, and you want your wealth to go from 5 million to 10 million, and you're on track, if you kept your company, because you could forecast out the financials based on the 3-statement forecast, like, I know I can get this. And if I look at the 4 KPIs, I know that, like, hey, based on these 4 KPIs and viewing it through the owner's utility lens, like, I know that my time, cash flow, and wealth are hit. And you can see when you're decoupling yourself from that operations, and it should be an investment decision at that point. This is giving me a good rate of return and a good set of cash flow, and we're growing equity value, and I don't have to spend my time in it. So, like, okay, great. Like, that's worth a lot to you. And you have the influence over a huge infrastructure that can provide a huge impact however you want to. And then the 4 KPIs are helping you say, okay, well, if I'm at 2 million normalized EBITDA and I can get a 7 from an ESOP, private equity sale, third-party sale, great. Well, how do those buyers and the deal structure based on that specific buyer impact my goals? Well, in an ESOP, like I said, so in ESOP, the rule of thumb is you can get about half your money at closing. So on 7 million, it's $7 million bucks out of 14. You got to pay taxes on that and pay off any debt. Okay. Does that fill your gap? I don't know. You're like, hey, shit, like, I might as well do this because, I want to, I'm totally fine. And, like, I'm willing to carry the risk. I believe in the company. I want to preserve the company. You might be able to go get $15 million from a third-party buyer But that third party buyer is only going to give you how much at closing? It might be an asset sale. Well, what's all the ramifications of that? Maybe the buyer doesn't, line up with your culture fit, or a private equity firm can get, you start to weigh all of those people against each other. Look at the 4 KPIs and then look at your time, cash flow, and wealth goals. And you go, I don't know. Like, you're looking at this through a lens to say, I can solve for something that gives me options to begin with. Then I stack up the different ideas of the market valuation lens of the 4 KPIs. Then I can look at specific buyers and exactly how they would structure the deal, what it means to me, how does it impact my role, how does it impact the company. And by understanding what's driving these people, what's driving these people is important. What's their mandate? Like, if they're going to buy this company, what's going to happen? Okay, what constraints are going to be put onto it? Like, is it going to be loaded with debt and I still have to accomplish all my goals? I think the rule of thumb that I keep going back to is there's no easy way out. There was a lot of dumb money in the system for years because we printed a lot of money. A lot of people had a lot of money and they were chasing returns because we had 0% interest rates. That game has changed. So we're back to the name of the game is cash flow. And so by understanding how all of these different ownership structures have to deal with that constraint of providing a return for their investors based on their investors' wealth goals, you're hooking yourself up with a game, and understanding whether that game matches with your game is the name of the game. So I hope this helps. Lens 2, I didn't change that. It's lens 3. That's what we were talking about. Is relevant when there's something at the deal table. I highly recommend, if you get an out of the blue offer, if you've done all this hard work, you then have the ability to make it go through a process to say, okay, like, I want to go through this process to maximize, like, I've made the decision that I'm going to sell to a third party. Great. How do I compare all those different third parties against each other, against my goals? I will be doing a couple other videos on these in the future. You can take a screenshot of this. I've got an ESOP mini series on the podcast on my YouTube channel if you want to check that out. The first 4 episodes are like 9 hours that I break all this down. I'll do a whiteboarding video at this at some point. And then private equity, same thing. I will do a whiteboard video on this and how it works. I think it's just, we've hit an hour and a half. You're a saint if you're still here. Put some comments in the YouTube comment section below. I'd love to hear your thoughts on what your questions are. I'm going to keep putting a lot of videos out this. Go check out the other 2 videos of the market value and the owner's utility lens. What we just covered just today was the plan phase inside the expand knowledge, which is we want to understand the game of ownership. And this is the framework to think through all of this with. Decouple your time and cash flow while building wealth, keeping an eye on independence. And we need to plan, build, and elevate ourselves. And by using our constraints of time, cash flow, and wealth, and you just breaking through those constraints and increasing more throughput of cash, which will decouple your time and your cash while growing wealth. The goal is to keep this flywheel going so that way you get rewarded for your hard work because you're doing the good work. And I do believe that you, as a business owner, should be able to do whatever you want. That's why we take all the risks. You've created a bunch of value. Now it's time to harvest that value by taking your time back, creating something that's worthwhile to yourself or to anybody. Hope you enjoyed it. See ya.